On July 4th, the big beautiful bill was signed into law, and it contained some important tax changes for everyone, especially small business owners. So if you own a small business, here are some of the biggest changes that you'll see in the coming years when it comes to your expenses. My name is Noah and I run York Wealth Management, and I help small business owners with personal and business financial planning in order to accomplish their goals. Many small business owners are completely unaware of how much a tax bill like this directly affects their expenses. So I'll try to walk through not only the big broad bill changes, but also some specific ways in which will affect your bottom line. First is tax brackets. These were set to expire in 2026, but under this new bill, they're extended for another 10 years. That means that most people will continue to see tax savings of around 2%, as opposed to what would have happened had we gone back to pre-2017 tax rates. But one of the biggest benefits is the simplicity that it preserves. Before 2017, many people itemized deductions in order to save on taxes. But once the standard deduction was almost doubled, lots of people, especially business owners, opted to take the standard deduction instead of itemizing. That trend will continue, and it's estimated that almost 90% of people are going to take the standard deduction going forward. Next is the qualified business income deduction. This isn't a new deduction, but the rules around it have changed significantly. If you're not familiar, the QBID allows small business owners of pass-through entities, such as LLCs, S corporations, or sole proprietorships, to deduct up to 20% of their qualified business income. This was meant to expire in 2026, but under the new act, it's permanent. But here's where it gets important. Not everyone qualified before. If you were in a specified trade or business, such as a lawyer, a doctor, or even financial planner, then the ability to take the deduction phased out as you got to higher income levels. And that limitation is still in place, but the threshold has increased dramatically. The new phase-outs will allow higher income earners to take advantage of the QBID when they wouldn't have been able to before. There's also something called the W-2 wages and qualified property limitation. This applies when your income is above that threshold, and it specifies how much of the deduction you can still take. So here's how it works. You get the lesser of 20% of your qualified business income, or the greater of 50% of W-2 wages paid by the business, or 25% of W-2 wages, plus 2.5% of the unadjusted basis of any qualified business property like real estate or equipment. That seemed very confusing, but basically you get the lesser of two of those options. But why is this important? Because if you don't have W-2 employees or any business assets, your ability to take the deduction starts to phase out as you reach higher income levels. But with the new higher thresholds, more business owners can qualify before those limitations kick in. And on the other side, for small businesses and small side hustles, there is a $400 minimum QBI deduction. The qualification is that your business has to earn at least $1,000 in profit. 20% is a huge number when you're talking about a deduction and money that you don't have to pay taxes on. So arguably the thresholds and limitations around this part of the bill are going to have the biggest effect on small business owners and the amount of taxes that they pay. Next up is the estate and gift tax exemption. In a previous video, I talked about the gift tax and estate tax and how those two things are very commonly misunderstood. Well, this bill made some notable changes. As a reminder, you get a lifetime estate and gift tax exemption, currently at $13.99 million. This means that when you die, your estate can pass along tax-free up to that amount. Anything over that is taxed, and if you give annual gifts over the annual gift tax exemption, that is subtracted from your lifetime estate tax exemption. So what's the big change in this bill? Well, that $13.99 million was set to drop to $7 million in 2026. But under the new bill, it's not only not going to drop, it's actually going to increase to $15 million per person. It is worth noting that the annual gift tax exclusion is still in effect, which as of right now is $19,000. The reason this affects business owners is because if you're trying to pass your business down to your kids, this gives you a lot more flexibility in ways to approach doing that. Whether it means you're doing it gradually over a period of time, or if it's worth under the estate tax threshold, you can pass it down all at once and you may not have any tax ramifications that your kids would have to pay. Next is the Section 179 deduction. If you've ever bought a vehicle, equipment, or computers for your business, you've probably used this deduction even if you didn't know it. What Section 179 allows you to do is deduct the full cost of particular business assets assets rather than depreciate them over time. There is one key point in that this only applies to businesses that actually have taxable income. So you can't use it to create or increase a loss. And it is different than bonus depreciation, which allows you to take 100% depreciation regardless of your income. The catch here is that bonus depreciation is being phased out gradually. So most people are probably going to take advantage of Section 179 instead. And thanks to the new law, the maximum deduction limit was doubled to almost $2.5 million. So this is a big win for small businesses that grow by investing heavily in machinery or other assets. And finally, a very practical change, the 1099 reporting threshold was raised. Previously, if you paid a contractor more than $600, you had to write a 1099 NEC for them. But that threshold is now $1,000. But here's where it gets tricky. Not all payments are included. If you're paying for things like rent or legal services, those things still require a 1099 even if they're under that reporting threshold. But the bottom line is that you're going to have fewer forms to file if you have casual or part-time contractors. You do still need to track your expenses with those people carefully, but you may not have to file an entirely separate form with the IRS. These updates may seem like fine print, but they're going to make a massive difference in the amount of taxes that you pay. And if you're like most small business owners, you're too good and too busy doing what you do best rather than getting bogged down with an 800-page long bill. If you want to know in more detail how this law might affect you, I am doing a limited amount of 30-minute meetings this month to go over how the One Big Beautiful Bill Act might affect you specifically and your small business. No prep or tax returns needed, it's more of a conversation, but the link for that can be found in the description.